Hey, welcome back to part 3 of JPMorgan v Chinese internet stocks. And in this video specifically, we will just be focusing on Alibaba and Alibaba only. So the JPM report actually outlines a few critical factors that I think most investors should actually know about because they are essentially Wall Street. And it's important to know how and what Wall Street thinks and expects, at least in the short term. So you know what else I'm expecting? You smashing that like button, of course, so help me get to 88 likes. So just a disclaimer before we dive into the report, as this is some sort of a professional report, it might get a little bit technical and a little dry at times when they explain their logic and arguments with many numbers. So I'll actually try my best to make it more entertaining, but no promises. Oh, and before I forget, Weibo recently just penetrated into the Singapore market. For those of you who have yet to create a Weibo account, go sign up using my sign up link in the description box down below and get up to USD $100 worth of Apple share. Don't let this free money slip away. So you came for the report, you get the report. So the first headline description of this Alibaba report by JPM is to first manage the expectations of the multitude of investors reading it. So you must be thinking, how bad can it get? So evidently, worse than where we are at now. So I believe that it's public knowledge that China is dealing with a great deal of problems domestically. However, the silver lining is that the current low valuation of the company should kind of ease the impact of share prices for the consumption weakness of the consumers in China and also the consistent disruption of lives and livelihoods because of the COVID lockdown. So in layman terms, the stock is too cheap to ignore, and even after bad earnings, which might happen in the upcoming earnings, it might not send the stock further down because we are currently already visiting the floor of the valuation on its current business alone. So I think it is also timely to revisit the fundamentals of valuation in the world of finance. At the end of the day, only earnings and cash flow matters, regardless of the company. So the story behind the stock is good to rally and excite investors, but if they don't produce results, it all fades away inevitably. So it doesn't matter if you promise to cure cancer in 5 years, if you can't deliver, you're giving shareholders cancer instead. So JPM turned positive on Alibaba for 4 key reasons. Number 1, e-commerce will be one of the early beneficiaries of recovering from the current COVID state in China. Number 2, e-commerce stocks get to enjoy 2 specific price drivers, which include firstly, the multiple re-rating, and secondly, the positive earning revision once the market looks through the entire pandemic issue in China today. Essentially, due to the current beaten down valuation of these Chinese equities, specifically in the e-commerce industry, they're expecting an easy beat on earnings across the board once they are able to tide through these challenging times, which quote-unquote presumably be transitory as well. And also, because the current multiples on these tech stocks are in the low to mid-teens, it's easy for these tech stocks to experience a multiple expansion from 10 times to 20 times, compared to some other industries with multiples of 50 times, and investors are hoping it to expand to 100 times instead. So it's of 2 different magnitude, even though both are quote-unquote expanding by the multiple of 2. Of course, I understand the argument of rating it with a low PE because of the low expected growth moving forward. And trust me, the upcoming earnings report for Alibaba is probably going to be an ugly one too, especially when Tencent, which is the behemoth in China, reports a 0% year-on-year growth. So if the company is stagnating, they won't be deserving of a 20x multiple, despite it being a quote-unquote tech company. So here comes the fun part. It is then your judgment on whether you think the growth of these Chinese internet companies are permanently impaired or they're not. So if you think that these companies will no longer grow, then it wouldn't even be worth 10 times price to earnings today. So if you think that they will continue growing, then you better start grabbing your shovels at this sort of valuation. However, you will then have to ascertain what this growth rate would be. So what I can say is that based on Wall Street's consensus, at least projecting out for the next 2 to 3 years, your bigger Chinese internet companies like your Tencent, your Alibaba, your Baidu are still poised to grow in the north of 10 to 15%, while the smaller ones and the up and rising ones like Meituan and JD can do more than 20% year-on-year growth. So these numbers are not pulled out from my ass, by the way. They are your bankers and your so-called experts in Wall Street that probably have much more data points compared to us as retail investors when they try to triangulate and to understand what is the growth opportunities ahead. So you choose who you want to trust. Also, I realized that there are some viewers currently commenting that when you Google Alibaba stock, Google actually returns the PE of Alibaba to be at around 24 and 25 rather than the so-called 10-ish PE multiple. So just a quick note, because the EPS for Alibaba was impacted by many one-off inclusions, such as the fine, the investments in strategic initiatives, which seem to have slowed down as they have captured significant amount of market share in a short span of time, and also the consolidation of the few acquisitions they had into the financial reporting itself. So if you're to look forward from here on, even based on JPMorgan's conservative estimate, as they put it, Alibaba is currently trading at 10 times price to earnings on 2023 expected EPS. Number 3, JPM determines that Alibaba has the highest upside potential just based on the sheer fact that they are trading at the lowest PE multiple within the entire China e-commerce space. And even though I understand that many of the naysayers will say it's a lazy way to draw the conclusion just based on PE, but we just cannot escape from that fact that it is trading at a cheap valuation. And last but not least, number 4, JPMorgan actually expects adjusted EPS growth to recover over 30% starting from Q4 of 2022. So for my viewers who are obsessed with the numbers and valuations, JPMorgan's December 2022 target for Alibaba specifically is $130 based on a 15 times calendar year 2023 expected price to earning ratio to see through the near-term impact from the lockdown and also a reflection of a more balanced sector view moving forward. So they believe that 15 times is fair given that their forecasted EPS from 2023 to 2025 has a CAGR of at least 18%. Now, here comes the worrisome part, especially from a number crunching perspective. Since we are just days away from the earnings of Alibaba financial year ending 2022 reporting, let's just put that aside and await for their results. Because honestly, we can't move the results, it's already set in stone. So JPMorgan's one-year projection into 2023 signals a 5.7% top-line revenue growth, a continuous shrinking of margins from 35.7% to 34.9% in 2023, and also the return of capital employed from 10.2% to 8.7% in 2023, and ultimately a drop in free cash flow to firm by 30% in 2023. So many of these numbers are extremely ugly, by the way. I'm not going to sugarcoat it. If these are normal times, producing this sort of results will warrant it to be thesis changing. However, the only thing existing investors are clinging on to is just blaming on the pandemic and things will quote unquote hopefully return to normal. So I don't like to invest with hope. So right after this upcoming earnings report, I'll be revisiting and re-evaluating my entire valuation model to account for these new adjustments because previously I've not taken into account a plausible another second round of COVID lockdowns in China, and I will no longer use the lazy way of just using a simple projection from year 1 to year 5 and then year 6 to year 10. Good news, I will probably have more bandwidth and capacity to relearn and revisit all my finance and investing related concepts. So do remember to subscribe and smash the like button if you want to follow on this clown's journey on investing. So moving on from the numbers, there are a few key downside risks that you should keep a constant lookout for as well. So firstly, other large internet companies such as Tencent and Baidu could also pose a threat to Alibaba's local services businesses. Essentially, given the new strategic importance the government actually placed on the service economy and its domestic consumption figure, it is expected that all of the big tech companies in China are going to support this initiative moving forward, further compressing margins and enhances the idea of common prosperity. Secondly, the strategic investments that are constantly being mentioned in the recent earnings call is an oddball. So it's currently not transparent at all, and we don't exactly know how long this so-called investments in strategic pillars efforts will last, and the pressure on the bottom line will continue to persist on. Thirdly, the sustainability of the China's retail marketplace GMV and also its revenue growth remains largely unknown in the longer run because of all this massive amount of headwinds in China's economy today. So although many of us like to believe that the Chinese growth story will act as the biggest tailwind for e-commerce, but due to the recent contraction and pressure on the economy, it is definitely casting serious doubts on their continued execution and prospects to continue growing, at least in the near term. So hope that you have enjoyed this 3-part series on JPMorgan v Chinese internet stocks. If you look forward to more of such content, remember to comment down below and I'll see you in the next video, but more importantly, I will see you on the moon. Goodbye!